So a few weeks ago, I released a video where I shared one of my subscribers' trades where he had followed a strategy that I shared on my channel and he has done pretty well. So ever since I released that video, I've got quite a number of positive feedback on that. And at the same time, I've got quite a number of questions on the details of the strategy. What is the entry and the exit as well? So I thought I'd create this video to go into a little bit more details on this credit spreads trading strategy that he actually did. So in this video, I'm going to share with you a simple credit spread system that you can use even if you're just starting out. First, let's talk about the entry rules. So for the entry rules for this strategy, you do want to prepare a watch list of stocks that you want to trade. So generally, if you want to trade the bull put spread, which is the bullish version of the credit spread, the put credit spread, then I typically prefer to trade it on fundamentally strong stocks. So fundamentally strong stocks basically means that the company is profitable. Now, of course, there are many other criteria to that, but the general consensus is that if the company has been making money for at least the past 5 years and is increasing its revenue as well as its profit, then I would consider that at least a candidate for a fundamentally strong stock. So this is where I would generally use it to trade put credit spreads. But you can use it to trade the bear call spread as well. And for bear call spread, the criteria is actually much simpler. You don't need fundamentally good stocks. It can be any stocks because when you're trading the bear call spread, you actually want the stock to go down. So in this case, most of the stocks are actually not fundamentally strong. So you can have a watch list of all these stocks, just put in the watch list so that you can cycle through them as you start to plan the trades. Now, once you've done that, this is step one. The next step is to look for oversold or overbought signal using indicators. So there are a few indicators, right? The main ones are stochastic oscillator. So this is the one that I actually have on this screen down here. And then there's another one that is the RSI. So it's up to you which one you want to use. But for this examples, I'm using stochastic, which is the slow stochastic. And I'm using it on a daily time frame. So you can use the same as well. And if you're wondering what's the settings of this stochastics, then just go ahead to my channel and just type in stochastic. And I've already created a video where I give the exact settings that I have for this stochastic. So the whole idea down here is we are looking for the oversold signal if you want to put on the put credit spread, which is the bull put spread, and you are looking for the overbought signal if you are planning to trade the call credit spread, which is also known as the bear call spread. So these are ways that can at least help you have a better entry compared to if you were randomly enter into it. So for example, when it is overbought, it just means the market has gone up quite a bit. So usually this is a time where the market can probably pull back or maybe even have a reversal. And this is where you can have potential trades. Now, of course, not all the time you want to enter. There are certain set of criteria in the other steps, which I'll show you later on. And as for oversold, this is where you're looking to put on the bull put spread. Again, this is the place where usually the market has sold off quite a bit. Then you put on the put credit spread. And if you couple this with a fundamentally strong stock where you know that the bias is towards the upside, then again, you have the odds in your favor. The chances of it going up will be higher than it continue to go down. So this is for step two. Now, step three, a very important one. See if the stock has earnings coming up in the next 30 days. If there is, then you don't want to trade it because when you're trading into earnings, then all this odds that we have on our side, where you're looking for oversold, overbought, and later on I'll talk about the support and resistance, doesn't really matter anymore because that's where the sentiments come in. If people are not happy with the kind of earnings that came out, then they're going to sell the stock, or maybe sometimes the stock will just gap up. So there's no real rationale behind how earnings work, and there's studies done as well by Tasty Trade team that even though you know the results of the earnings beforehand, you still cannot accurately predict where the market will go to because it can be a good result, a good earnings, but the market sell it off. Or it could be a very bad earnings, but then the market can still buy it up. So that is why we want to avoid earnings because it can be unpredictable. So how do you know whether the stock has earnings? Well, one simple way is to go to your option chain. So for this option chain, you can see that there is a line over here. This is by Tasty Trade. Thinkorswim also has this. So if your broker doesn't have this where it indicates the earning, then maybe it's time to change broker, or you can just go to the website and then look for earnings. There are many sites that tells you about upcoming earnings where you can look for it. But the simplest way is just to look at the option chain. And if you see that it's within the next 30 days, then you definitely do not want to enter into it, right? Just skip for the next trade. Now, step number 4, this is where you identify support and resistance levels. So this is a very important and integral part of this system because you want to add more odds on your side to let the probability favor the trade. So that is why you want to identify support and resistance levels. So in this case, as you can see, we are identifying a support level because as you can see over here, this is oversold. Stochastics is oversold. That means we are looking to place a bull put spread to play to the upside. We want a bullish move in the underlying, then that is how the bull put spread will make money. So let's just say over here it's oversold. So it should be somewhere in this region over here. So once you see it's oversold, you want to identify the previous support level. So in this case, I've identified it here. This is where the previous low is. So all you got to do is just draw a line across. So this is where we're going to have sort of a defense line, whereby if the market does actually come down, then at least because of this support, there is a chance the market can bounce back up. Now, of course, not all the time it will bounce back up. There'll be times that it will continue to go down and you lose on the trade. That's normal, right? It's not possible to win 100% of the time. You just need to know that if you play with the probabilities over the long term, the edge will play out. So once you've already identified the support or the resistance levels, if you want to trade the bear call spread for the resistance, this is where you start to sell your credit spreads. So in this case, if you are trading the bull put spread, then you want the bull put spread to be below this support level. Okay, so you see that we have a few things on our side. Firstly, we have the stochastics that says it's oversold. And then next, we have identified the support level, which is down here. And then next, we want the bull put spread to be below the support area. So this way, at least, again, like I mentioned, if the market comes down, and if it does find the support here and it bounces back up, then your bull put spread down here would not be breached at all. So as you can see, this is considered at least pretty strategic rather than you place the bull put spread somewhere here, very random, right? Now, as for the DTE and the short strikes, this is where we want to choose around 45 DTE. So why 45 DTE? This is something that I've talked about in a lot of my videos. So if you have seen a number of my videos, then yes, you already know why 45. But for those of you who are new to my videos, who probably these are the first few videos that you have seen, then the reason we want to go with 45 DTE is because this is where our edge lies. We actually have an edge in options trading, whereby the realized move is more often the time lesser than the expected move. So I won't go into too much details down here because I've already created a separate video where I go in depth into this edge. And this edge is very important for us as option sellers. If you want to have this edge, then it's always around 45 DTs and above, not below. So this is why we want to go for 45 DT. Now, as for the short strikes, we want it somewhere around 30 deltas. So let's just say, for example, the moment you see that it's oversold and you know that you want your short put strikes to be around 30 deltas. So what you do is you go to the option chain now and you take a look at the strike prices that is below this support area. So let's say this support down here is maybe around $61. So what you want to do is you look for the strike price that is below $61 and you take a look at the delta. If the delta is showing that it's around 30, then you're good to go. But if it's maybe too low, maybe it's like 10 delta, then it just means that it's a little bit too far away. Now, can you put on the trade if it's 10 delta? Yes, you can, but it's going to be a little bit lopsided in the risk to reward. So you do have a high probability of win, yes. However, you'll notice your credit is not going to be that high. So we want to have a fine balance between them. So what do you do then if you cannot find the short strike that is 30 deltas by the time when you see this oversold signal? So what you got to do, very simple, just wait for the price to trade a little bit lower. So once the price trade a little bit lower, the same strike price which we were looking at previously, maybe it was 10 delta, it could now get a higher delta because now it's closer to where the current market price is. So maybe it's gone up to around 30 deltas, then this is where you can actually start to place the trade. Now, some people have asked me, but Davis, what about if the trade is around 20 deltas or 25 deltas or maybe 40 deltas? Then yes, if you want to, you can as well. Just remember, there's always a trade-off. The trade-off in options, especially for selling options, is that if you have a higher delta when you're selling the put option, you have higher premiums. However, you have a lower win rate. On the other hand, if you go for a lower delta, you have higher win rate. You win more of the time. But every time when you win very little, which means to say whenever there's a loss, which will happen from time to time, the loss is going to be much bigger in the ratio compared to the premiums that you make. So that is why there's a fine balance in between. So for me, I give you a guideline which is around 30 deltas. So this is for the put spread. Now, if you want to go for the bear call spread, then it's just the opposite. So you just look for the resistance and then you want to sell the bear call spread above the resistance. Okay, so this is for the entry rules. As you can see, pretty simple. Now, next, what about the exit rules? So there are a few methods that you can use. So the very first method is simply exit at 21 DTE regardless if it's a profit or a loss. Yes, you heard that right. Regardless if it's a profit or a loss. Some people have asked me, but Davis, at 21 DTE, I'm in a profit. Why do I want to just cut it off now? Why don't I let the trade run? And the answer is yes, you can let the trade run, but remember, over the long term, if you always exit at 21 DTE, there'll be times whereby you exit at 21 DTE, after that the markets, let's say you're trading the bull put spread, the market comes down. And then all of a sudden you lost all the profit. But because you have exited at 21 DTE, that kind of saves you a little bit. You have managed to take in profit before the move down. Now, of course, the other side can happen as well because you may have exited at 21 DTE, the market continued to go up for the bull put spread. So the reason why you want to choose 21 DTE is because it's statistically proven and we want to always rely on statistics to determine our exit and entry rules. And it's that based on 21 DT, you'll see that the performance over time is much better than if you were to hold to expiration. So as you can see over here, this is a study done by the Tasty Trade team where they compared the put spread based on different spread width of the credit spread. They manage it at expiration. That means they exit at expiration, then they put on a new trade again, compared to they exit at 21 DTE, then they put on a new trade again. So the first thing you will notice is that the win rate is not as high. Yes, the win rate is lesser than holding to expiration. However, if you take a look at the returns are actually higher. So this is one important aspect to understand is that although you may have the max profit by holding to expiration, you need to realize that there are times also you could get the max loss. So if you take a look at the average loss down here, you'll notice that if you were to manage at 21 DTEs, your average loss over time is going to be significantly lower than if you were to hold to expiration. That is why over the long term, your returns is higher when you manage at 21 DTE. And there's another important aspect as well, why you want to exit at 21 DTE, and that is the risk of early assignment. So this is where the danger actually comes by holding to expiration, because you're trading on individual stocks or maybe even on index ETFs. These are what you call American style options. That means to say the buyer of the options have the right to exercise the options at any time before the expiration of the option. So if your credit spread is actually in the money and it's nearing expiration, then there's always a very big chance that the buyer option will exercise that option, and then you're going to be assigned the shares. Either you're going to be long shares or you're going to be short shares, depending on which credit spread you're doing. So once you get into an assignment, this is where you can get into a margin call as well. But if you were to exit early at 21 DTE, then that actually reduces the chance of early assignment by a lot, because at that point of time, at 21 DTE, there's still quite a lot of extrinsic value. So the only time really when somebody will actually exercise the options is when there's not much extrinsic value left in the option. And that's usually the time when it's very near the expiration date of the option or when it's very deep in the money. So if you were to exit at 21 DTE, you save all the hassle and all the troubles of getting assigned and then getting into a margin call. Now, this 21 DTE exit is not just applicable only to put spread. It's actually applicable throughout all different option strategies, and this has been proven by the Tasty Trade team as well. As you can see over here, this is of the Jade Lizard. So you can see the Jade Lizard, if you were to exit at 21 DTE, again, overall you get a better return. Then this is for the 30 delta put option. As you can see, just a very simple short put. Same thing as well, exiting at 21 DTE, although you have a lower win rate, you overall get a higher return. That is exiting at 21 DTE. And same thing as well, this is for the strangle. If you exit earlier, in the end, you're still going to get slightly better performance. As you can see over here, this is the daily P&L. Daily P&L, when you exit at 21 DTE, is the highest. So if you want to have a better return in the long term, not just 1 or 2 trades or 10 trades, over 100 trades or more, then you want to exit at 21 DTE. And at the same time, if you do not want to get into early assignment, then exiting at 21 DTE is the way to go. Now, What about the second method? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So the second method is a combination of two things. It's an exit at a percentage profit or 21 DTE. So we always have the baseline of 21 DTE to make sure that is the latest that we exit. Again, regardless if it's a win or a loss, because we know over time, the statistics have shown, as long as you cut at 21 DTE, even if it's a loss, you're still going to be having a better performance than if you hold to expiration. Again, remember, this is over the long term, not over 10 trades. So don't say, oh, Davis, I took 10 trades and it seems like holding expiration is better. It's just 10 trades. I can flip a coin 10 times and I get hits 10 times. Does it mean that this coin is only going to get hits if I flip it about 1,000 times? Definitely not. Over 1,000 times, it's going to come out roughly 50-50%. So same thing as well in options trading. Everything is about probability. So regarding the exit at percentage profit, it's actually pretty simple. So when you're selling the option, you always want to buy back at a lower price. So let's say, for example, I sold the credit spread at $2. So how do I know if it's at 50% take profit? Let's say I choose 50% take profit. Then all you got to do is wait until this drops to $1, then you can take profit, right? So you sold at $2. This is the premium you receive. You buy back at $1. You give back $1. You get $1 in profit. So this is 50%. Now, what about 75%? It's the same thing as well. You sell at $2, and then all you got to do is just buy back at 50 cents, if my maths did not fail me. So basically, once you buy back at 50 cents, you got $1.50 in profit. So this is about 75% profit. So you can use a combination of these two, whichever comes first, either a fixed percentage or 21 DTE. So this is for method number 2. And finally, method 3, this is the one that I actually do not recommend the most, especially if you're new to options trading. And that is a discretionary exit. So this is something whereby people have asked me before, Davis, I use technical analysis, I use some mumbo jumbo indicator, I look at the stars, the moon, and all that stuff to determine my exit. Can I use that? Well, the answer is you can if it is working for you, right? So whether it's going to outperform method 1 and 2, the only way to know is for you to actually test it out, because discretionary exit 100% relies on your skill as a trader. So if you're so good that you can time the market at the point of time where your exit is the best exit of any other exits, then by all means you can do that. But if you want to be objective, whether your exit is actually going to be better than either method 1 or 2, which has been statistically proven already to have done well over a long period of time for about a decade or so, then you want to test it out. How do you test it out? You trade one method that is according to the Tasty Trade parameters, which I mentioned, method 1 and 2. And second part is your own method. So you put it across 100 trades or more, measure performance, and if you see that yours is better, by all means, go ahead and do that. Okay, so this is the entry and exit rules. Now, at this point of time, inevitably, there will always be people that ask me, Davis, what about a stop loss? Why don't you mention a stop loss? So here's something very interesting and something that you probably need to know about. And that is that a credit spread already has an inbuilt stop loss from the long options, if you didn't realize that. So as you can see over here on the left-hand side, this is the put credit spread. So what does the put credit spread consist of? You have a short put and then you have a long put. What does this long put do? This long put actually limits your max loss. That means to say, if you want a maximum risk of $500 per trade for that trade, then all you got to do is just put that long put maybe about 5 points away. If you put it at 5 points away, there's no way you can lose more than $500 because you've already capped the loss with this long put. So this is an inbuilt stop loss. So why do you want to have a stop loss on top of a stop loss? You see, it just doesn't make sense on a credit spread, or rather on any spreads, because these spreads already have this embedded long option that stops your maximum loss. So what does a stop loss do? A stop loss just caps your maximum loss, and that's what this long put do. But there's one added advantage of this long put, or even the long call. So this is for the bear call spread. So this is one advantage of the long option compared to a normal stop loss. So let's say you have a normal stop loss. If the market comes down here, and let's say you put your stop loss at the same place at where the long put is, you're already out of the trade. And then let's say if the market bounces back up, you're no longer inside the trade. But with this long put in place and you do not have that stop loss, because this long put is the embedded stop loss, if the market actually comes down, yes, you will see that you are in a drawdown, you're losing money, but number one, you do not lose more than what you actually have already risked for the trade, which should be the parameters which you set for the trade in the first place, where you identify the stop loss. And secondly, you're not out of the trade because the market can eventually bounce back up and you still are able to eventually be in a profit. So this is the beauty of having this long put in place, or rather this long call, this long option basically. So this actually serves as a stop loss and you do not need a stop loss. Now, if you're wondering, Davis, what about the statistics? Can you show some statistic that stop loss actually doesn't even work for credit spreads? Well, I'm glad you asked, because the Tasty Trade team actually already have done a lot of studies on this. As you can see over here, this is the study on a put spread where they measured 2 times the loser. So 2x loser, the stop loss is at 2 times the premium that you receive. So as you can see over here, in the long term, over a number of trades, as you can see, this is from 2006 all the way to 2017 or so, which is about 10 years plus, you will see that if you were to hold to expiration, you will actually do better than if you were to cut off at 2x losers. So based on the studies, you can see over here, having a stop loss actually does not do you better than just having the credit spread by itself and hold to expiration. Now, you might be asking, but Davis, this is 2x loser. I have a different stop loss. You know, I have a bigger stop loss, maybe at 3x, 4x, or 5x. Well, guess what? The Tasty Trade team also already have done studies on that. And as you can see, all those X losers, whether it is 2x, 1x, 5x, and so on and so forth, it just does not do better than holding to expiration. So hopefully this gives you a better understanding about stop loss, but if you still insist on putting a stop loss thinking that you have a different style of stop loss, maybe it's due to technical analysis, due to some indicators, so on and so forth, then by all means, go ahead and implement it, but be objective again, like I mentioned, compare it against the Tasty Trade studies and see in the long term, over 100 trades or more, which one actually does better. Okay, now let's get into some examples of how to put everything together, how to enter and also exit the trade. So as you can see over here, this very first stock. So the first thing we look at is for overbought or oversold signal. So over here, the stochastic has already showed that it's overbought. So this is the very first condition that has been fulfilled, is overbought. Now, the next thing you need to do is to identify resistance levels, because now we are going to trade the bear call spread. We want the market to actually go down. So we're identifying the previous resistance level. So this is where I look at the previous high and then you just draw a line across. So at this point, this is where you want to go to the option chain and you want to look for the short strikes that's above these resistance levels. So you go to the option chain and then you want to look for the short strike that is above the resistance level and it's also somewhere around 30 deltas. So again, if you cannot find that is 30 deltas, let's say it's below 30 deltas, then all you got to do, just wait for the market to trade up a little bit more. Then once it's around 30 deltas, then you can start to sell the bear call spread. So let's take a look at how this trade pans out. As you can see, the market did eventually trade upwards. So you can actually get into this trade and you can get pretty close to 30 deltas, maybe even 40 deltas if you want to, if you're a little bit more aggressive. And as you can see over here, it touched the resistance level and then subsequently it went back down. So this is where you can start to implement the exits, which I've mentioned just now. Either at 21 DT, just exit it, or you have a percentage take profit, like 50%, 75%, so on and so forth. And then once it goes down, you can take profit for that. Now, the next example, this one is on the bull put spread. So we want to trade it to the upside. So as you can see over here, this is on Palantir. So the market has been trending up very nicely. So another thing is that if the market is trending up and you're looking for a bullish trade like the bull put spread, then it tends to work better as well. So if you can get this also as well, where the market is trending up, then you trade the bull put spread, and the market is trending down, then you trade the bear call spread. This can give you an added odd in your favor. So let's take a look at this right now. So now it's oversold. So same thing, now it's oversold. You're looking to find the support level. So I've identified the support level as the previous low All you got to do, draw a line across, and then now you go to the option chain, same thing as well, and then you look to sell the bull put spread, the short put that is below the support level, and then see if it's around 30 deltas. If it's around 30 deltas, then you can put on the trade, and if it's not, then you can just wait until it trades a little bit lower before putting it on. Now, what if it never actually goes down low enough to be 30 deltas? Then guess what? You can just skip the trade. There are always many opportunities down the line. So that is where having a watch list of stocks is important. Have many different stocks on your watch list. Then this way you can cycle through each one. And once you find a suitable candidate, then you can place the trade. Now, the other thing I want to talk about is about the long put. So I've touched on it very briefly just now, where to place the long put. But basically, how you would place this long put is at where your risk is at. So that means to say, if your max risk is $500, then that just means that you want to stretch it at most, the width, to be $5 wide. So that means from here to here is $5 wide. Now, if you have a risk of $4, then it will just be $4 wide. So it goes according to your risk parameters. Now, one thing I do not recommend is to go to a very tight wing. That means to say you go for $1 wide. If you go for $1 wide or $2 wide, TC Trade again have shown studies that if you have such a tight wing, it's not going to work out well because it's just too close to where the short put is and it becomes very volatile because the market doesn't have to move much to actually take out the whole trade for pretty much a max loss, because by the time it comes down here, if you have a $1 width, it just takes only $1 for it to go below that long put. And then it makes it a very volatile trade because sometimes you have profits and then all of a sudden just $1 move below the short put, you're pretty much seeing a very big loss. So that is why TC Trade has suggested around $5 wide, and if you can go a little bit wider, even better still. So as you can see, the market eventually traded up. Then same thing again, just wait until it's around 21 DTE to exit, or maybe 50% or 21 DTE. Now, next example. So this example is on NVIDIA. So now we are looking at the overbought signal. So we are looking to trade the bear call spread to the downside. So look at the stochastics. It says it's overbought. Next thing, look at the previous high. Where is the previous resistance level? So there are a few resistance levels actually. You can use the one down here, or there's another one above down here as well. So both are okay to use. If you want to play it safe, you can go for the one right at the top down here. Okay, so for this example, I'm just going to use this one down here. So same thing. You just look at the option chain at this point of time, and then you see if it's 30 deltas, you put on the trade. If it's not, just wait until it becomes 30 delta before you put on the trade. So as you can see, pretty simple, pretty straightforward. And once it goes down, then this is where you can take profit again. So hopefully you've seen by now, it's very repetitive and it's actually very simple. These are the few things that you just look out for. So now that the market has come down, you notice what happens to the condition of the market. The stochastic is now saying that it's oversold. So now we can actually try and place a bull put spread. So same thing as well. So take a look at the oversold signal first. Once it's oversold, identify the previous support level. So previous support level is somewhere down here. Draw a line across and then take a look at the option chain. See the option chain, whether you can find the short strike below the support level. There's around 30 deltas. If you can, put on the trade and then just let the trade go. It could be a winner, it could be a loss, doesn't matter. Once you put on the trade, you just follow to your strategy, stick to it, and then let the odds play out over the long term. Now, finally, I'm just going to share with you one more setup. One more setup on Netflix, and you should pretty much get the idea right now how to place this strategy. So same thing, you take a look at this. This is now oversold. So oversold, we're looking to place the bull put spread. So you notice this time that the oversold signal happened somewhere around here. And if we were to draw the previous support level, it should be around here because this is the only real bounce off which we had. So over here, this is a gap down here. So I don't like to consider this as a support. This would be the place where I'm looking at. So same thing. If you were to take a look at option chain and you see that, hey, if you want to place a bull put spread that's below down here, and you see that the delta is so low, like maybe 5 delta, then I would suggest to just keep it first. Wait for the market to trade lower, as you can see, which it has, then you start to put on the trade. Because this way, when you have a higher delta, at least the risk to reward is going to be much more better than if you were to enter a bull put spread where the short put delta is like 5 delta. That's just way too far. Okay, so like I've mentioned just now, identify the previous support and then look for the short put that is 30 deltas below the previous support and then just put on the trade. And as you can see, eventually the market has gone back up. So far what I've shared with you down here are the examples that it went well. But there will also be times where you will actually have a loss. Remember, there is no trading system that's going to give you a 100% win rate. If you're going to do a 30 delta put, it just means the win rate is going to be around 70%. So if it's around 70%, you can expect that 30% of the time you will be in a loss. But again, remember, we treat this very mechanically. Just do this over the long term, and the edge, the probability will all play out in the end. So hopefully this video has been helpful for you. And if it has, I would greatly appreciate if you give me a thumbs up on this video and also subscribe to my channel for more videos like this. And I will see you in the next video.